Most people are staring at the wrong screen right now. They're watching stock tickers. They're watching headlines. They're watching price. But price is never the first thing to move. Pressure moves first. Flows move second. Availability moves third. And price only reacts after the system starts to strain. What's happening right now across global markets is not random. It's not coincidence. And it's definitely not disconnected. On the surface, it looks like three separate stories. Massive money pouring into U.S. equity funds. A record silver price premium in Shanghai over Western markets, and U.S. stock futures rolling over as trade tensions escalate. But underneath, these are not three stories. They're one, and silver sits right in the middle of it. Let's start where most people feel the safest, U.S. stocks. Over the last 3 months, more than $400 billion has flowed into U.S. equity ETFs. That's not a typo. That's the largest inflow ever recorded. Inflows have doubled since late summer. They aren't just be blown past the 2021 peak, the most euphoric moment of the last cycle, by a staggering margin. January inflows alone are running at 5 times the historical average. And here's the part almost nobody talks about. It's not just money coming in, it's how it's coming in. Leveraged long ETFs, funds designed to magnify upside, now hold $145 billion in assets. That's an all-time high. Funds betting on market declines, about $12 billion. That's a 12-to-1 imbalance between bullish and bearish bets, the highest on record. This isn't confidence, this is concentration. This is everyone leaning the same way at the same time with borrowed exposure. History has a very clear pattern here. When risk appetite is this extreme, the system becomes fragile, not strong. Because leverage doesn't absorb shocks, it amplifies them. And while capital is flooding into paper assets at record speed, something very different is happening elsewhere, quietly, without headlines, without CNBC panels, in Shanghai. Right now, silver in China is trading at a record premium over Western prices, up to $11 per ounce higher. Let that sink in. The previous record, during the 2011 silver mania, was around $7. This gap didn't grow slowly. It didn't take years. It quadrupled in just weeks. Shanghai silver prices surged to around $105 per ounce. Western markets sit closer to $94. That difference is not speculation. It's not sentiment. It's physical stress. Premiums like this don't appear because people are excited. They appear when metal cannot be sourced fast enough at any price. In China, silver isn't just an investment metal. It's a strategic input. Electric vehicles, solar panels, electronics, infrastructure. And China consumes more silver for industrial use than almost anyone on Earth. Now layer in export restrictions, supply chain controls, domestic priority rules. When China needs silver, it doesn't ask the global market politely. It pulls inward. And when that happens, the global pool shrinks. That's why Shanghai premiums matter far more than COMEX charts. They are the market screaming, quietly, that real metal is becoming scarce where it's actually used. Now here's where people get confused. They look at silver prices in the West and say, well, if there's a shortage, why hasn't price exploded? Because price is not the market. Price is the last reflection of the market. Western silver pricing is dominated by futures contracts, paper promises that can be created in infinite quantities. Shanghai deals in delivery. When those two diverge, it tells you something is breaking. And now we add the third piece. U.S. stock futures are rolling over. The NASDAQ is sliding. Trade tensions are escalating. Tariffs don't just change prices. They change flows. They disrupt supply chains. They force reshoring. They raise input costs. And when markets are this leveraged, when positioning is this one-sided, it doesn't take much to trigger forced selling. Here's the hidden connection. When equity markets wobble after extreme inflows, liquidity doesn't disappear evenly. It vanishes where leverage is highest. And when that happens, capital looks for assets that are unleveraged, scarce, outside the financial system. That's when physical metals stop behaving like paper trades. This is where silver's dual role becomes dangerous for the system. Silver is not just a monetary metal. It's an industrial necessity. You can't financial engineer solar panels into existence. You can't print EV supply chains. And when financial capital rushes into equities at record speed, while industrial demand quietly drains physical inventories elsewhere, you create a time bomb. Some will argue this is normal, that ETF inflows simply show confidence, that Shanghai premiums are temporary, that futures prices reflect reality. But those arguments only work in a world without constraints. And constraints are exactly what's showing up. If physical silver were abundant, premiums wouldn't exist. If inventories were healthy, delivery wouldn't be delayed. If leverage weren't extreme, markets wouldn't react violently to minor shocks. This isn't about predicting tomorrow's price. That's not how structural analysis works. This is about recognizing when systems stop behaving normally, when paper claims grow faster than physical supply, when demand concentrates geographically, when capital crowds into the same trades, when risk is priced for perfection. That's when silver stops being boring. That's when it stops trading like a chart and starts behaving like a resource. Most people will miss this. They'll wait for a headline, they'll wait for confirmation, they'll wait for price to tell them the story. By then, the metal won't be available the way it was before, because markets don't break loudly at first. They break quietly, through premiums, delivery rules, minimum orders, export controls, and invisible stress. Silver is not sending a signal through price alone. It's sending it through availability. And availability is the one metric no paper market can fake forever. What we're seeing right now is not a spike, it's not a squeeze headline, it's not hype. It's a structural divergence between financial confidence and physical reality. And those two worlds don't stay separated for long. When they collide, silver doesn't ask permission to reprice.